Have you been following the Canadian mortgage and housing market? If so, you know it's been quite a ride over the past few years. After aggressive rate hikes in 2022 and 2023, then cuts in 2024 and 2025, we are in a new environment. Canadian homeowners are now asking if it's safe to consider a variable rate mortgage in 2026. But before we get into that, please remember to like this video and subscribe if you find this content valuable. If you want to build wealth in Canada, you have to understand the tools available to you. On this channel, we explore the wealth-building strategies like real estate, RRSPs, TFSAs, financial planning strategies, and investing in stocks and ETFs in Canada. Let's get back to the video. You should know that the Bank of Canada rate decisions affect the variable rate mortgages, but not the fixed-rate mortgages. Fixed-rate mortgages are affected by bond yields, which are something completely different. We will get into this in another video, so remember to subscribe. Additionally, check the video description for the link to the article we wrote on this topic. As of December 2025, the Bank of Canada has held its policy rate steady at 2.25%. Canadian banking prime rate is generally at 4.45%, serving as the base for variable rate mortgages, home equity lines of credits, and unsecured lines of credit. However, lenders typically add a spread, like prime plus or minus 0.50% to get the final rate. This rate fluctuates with the Bank of Canada's policy, but the major banks like RBC, TD, National, Scotiabank, CIBC, and BMO are currently aligned at this level. A quick moment to mention HomeWise mortgages. They are the easiest way to get the best mortgage whether you are buying and need a pre-approval, refinancing your existing mortgage, or renewing to get a better rate. Complete everything digitally or over the phone, and they are so quick. They have access to over 30 banks and lenders, so they negotiate the best rate for you. Click the link in the description. Historically, fixed rates are higher than variable rates, but for the first time in years, variable mortgage rates, the blue line, appear lower than fixed rates in green. However, many Canadians are questioning the safety of going variable again. Can variable rates continue to go lower? Something that affects the Bank of Canada's rate decision is inflation. If inflation is too high, then the BOC will increase interest rates to slow consumer spending. This will increase variable mortgage rates. On the other hand, if the economy is slowing down, then the BOC will decrease rates further to encourage spending. Variable rates offer potential savings when rates are falling, but introduce risk during rising rate cycles. So compare options carefully and understand the potential for payment changes. Let's break down the current landscape. The Bank of Canada's policy rate is at 2.25%. A typical 5-year variable is 3.60%. However, a 5-year fixed is 3.99% to 4.19%. Right now, variable rates are approximately 0.40% to 0.60% lower than fixed rates. This contrasts with last year when fixed rates were the clear discount. So, what can we expect in 2026? Economists forecast stability, albeit with some uncertainties. Most major banks believe the Bank of Canada will maintain a wait-and-see approach for the first half of the year. While inflation sits near the 2% target, core inflation remains around 2.5% to 3.0%. Currently, inflation is in range, and there's no reason for the BOC to decrease or increase rates. This confirms the wait-and-see approach. There are 3 possible scenarios for 2026. 1. The soft landing. Rates could stay flat at 2.25% for most of the year, benefiting variable holders. 2. The recession dip. If the economy significantly weakens, we might see rates cut to 2.00%. This is a 0.25% decrease, also benefiting variable rate holders. 3. The inflation rebound. If inflation rises again due to trade policies or government spending, rates could increase to 2.50%. or even 2.75%. Now, why might 2026 be a good time to go variable? First, immediate interest savings. If variable rates hover in the mid-3% range and fixed rates approach 4%, homeowners save money right away. For instance, on a $500,000 mortgage, a 0.50% difference translates to about $200 less in monthly interest. Second, consider the recession hedge. In the event of a recession, the Bank of Canada often cuts rates to stimulate the economy. If you're locked into a fixed rate, you could miss out on significant savings during such times. Lastly, there's the penalty advantage. If you need to break your mortgage in 2026 or 2027, the penalty for a variable mortgage is usually just 3 months' interest. On the other hand, breaking a fixed mortgage can lead to astronomical penalties because you're breaking something that is fixed. However, going variable is not without risks. One major concern is the sticky inflation risk. If inflation rises again, the Bank of Canada may have to increase rates, affecting your payment structure. Additionally, if you're nearing the end of a fixed rate from 2021, moving to a variable rate could introduce uncertainty during payment renewal. For many families, locking in a fixed rate offers a guaranteed budget. Also, you can consider going variable to start, to take advantage of the lower interest rate for a few years, and then switching from variable to fixed. Some, but not all banks offer this as an option, but it's an important mortgage feature. So who should consider going variable in 2026? If you have a budget buffer and can handle a slight interest rate hike without stress, it might be a good move. Flexibility is also essential. If you plan to move or refinance soon, that leans toward the variable rate option. Moreover, if you believe the economy is slowing and rates are more likely to fall than rise, that supports going variable. Conversely, if you're at your maximum budget and cannot manage any increases, sticking to fixed rates may be wise. If you prefer to avoid the stress of keeping up with Bank of Canada announcements, a fixed rate might be the better choice. In conclusion, the danger zone of variable rates from 2022 to 2023 seems to be behind us. Now the spread between fixed and variable rates favors variable borrowers. In 2026, it's not about betting on rates dropping to zero, but rather maintaining a flat rate. If you can live with that reality, going variable could be a smart choice once again. For more insights, be sure to visit our website www.financiallywise.ca, as well as financiallywise.ai. Don't forget to like, share, and subscribe for more updates. Looking forward to seeing you in the next video.